Have you ever wondered how to maximize your investment returns with outsized risk? Today, let's dive into the world of exchange-traded funds, or ETFs, focusing on two heavyweight contenders: the Vanguard Growth ETF, known as VUG, and the Invesco QQQ Trust, often simply called QQQ. VUG boasts an impressively low expense ratio of just 0.04%, making it a frugal choice for cost-conscious investors. On the flip side, QQQ, while slightly more expensive with an expense ratio of 0.2%, offers a higher compound annual growth rate, or CAGR, and potentially better risk-adjusted returns. Understanding metrics like these, expense ratios, CAGR, and standard deviation, is crucial. Later, there will be an alternative fund discussed at the end that is half the expense of QQQ. Stay tuned as we delve deeper into the specifics of each fund, helping you decide which might be the better choice for your investment portfolio. Consider the expense ratio, a small number with a big impact on your investment. Vanguard Growth ETF, known as VUG, boasts a notably low expense ratio of 0.04%. In contrast, the Invesco QQQ Trust, or QQQ, carries a higher expense ratio of 0.2%. This difference might seem minuscule at first glance, but over time, these fees compound, influencing the total growth of your investments significantly. While VUG offers a lower expense ratio, let's find out how this translates into actual earnings. Now let's talk returns. After all, that's what really matters, right? When we peel back the layers on the Vanguard Growth ETF and the Invesco QQQ Trust, the numbers start to tell a compelling story about growth and potential. Starting with a similar initial investment of $10,000, the Vanguard Growth ETF, or VUG, has shown a respectable compound annual growth rate, or CAGR, of 11.29%. This growth translates to a final balance of $79,116. On the other hand, the Invesco QQQ Trust, commonly known as QQQ, pushes the envelope further with a CAGR of 13.88%, significantly higher than VUG. This robust growth rate escalates the final balance to an impressive $123,493. While these figures are indeed attractive, they merely scratch the surface of what investors need to consider. Higher returns often tempt investors, but it's crucial to consider the associated risks. Higher returns usually come with higher risks. Let's see if that's true for our ETFs. When we dive into the world of investing, volatility is often a guest at the party. For the Vanguard Growth ETF, or VUG, the standard deviation, a measure of how much returns can vary from the average, stands at 16.70%. It's a figure that hints at substantial ups and downs. In its best year, VUG soared by 46.83%, but it also faced a chilling drop of 38.02% in its worst year. The maximum drawdown, which measures the largest single drop from peak to trough, was a staggering 47.18%. Switching over to Invesco QQQ Trust, the stakes are slightly higher with a standard deviation of 18.51%. QQQ's roller coaster reached even greater heights and depths, 54.85% in the best year and a drop of 41.73% in the worst year. The maximum drawdown here was even deeper at 49.74%. With QQQ showing slightly higher risk, but better worst-year performance, risk tolerance becomes key in decision-making. But how do these funds perform when we adjust for risk? Let's dive into the Sharpe and Sortino ratios of Vanguard Growth ETF and Invesco QQQ Trust to uncover which ETF offers the smoother ride to prosperity. The Sharpe ratio, which measures excess return per unit of risk, reveals quite a bit about how efficiently each fund uses its risk. Vanguard Growth ETF has a Sharpe ratio of 0.64. This suggests a moderate level of risk-adjusted return. In contrast, Invesco QQQ Trust edges ahead with a Sharpe ratio of 0.72, indicating it provides a higher return for each unit of risk taken. Turning to the Sortino ratio, which focuses only on the downside risk, Vanguard Growth ETF posts a ratio of 0.97. Respectable, but still outpaced by the QQQ's Sortino ratio of 1.12. This higher ratio signals that QQQ has historically offered better returns in negative market conditions relative to the downside risk experienced. QQQ leads with higher Sharpe and Sortino ratios, indicating better returns per unit of risk. Now for a twist, what if there's another option that offers similar benefits at a lower cost? Enter the Vanguard Information Tech ETF, commonly known by its ticker, VGT. This ETF provides exposure to some of the biggest and most influential tech companies in the market. It mirrors much of the tech-centric performance that investors seek in options like QQQ, but comes with a notably lower expense ratio. VGT boasts a robust track record, showing strong performance trends in the tech sector. It's designed for those who are bullish on technology but are also keen on minimizing investment costs. The lower expense ratio can translate into significant savings over time, enhancing the overall return on investment for cost-conscious investors. Moreover, VGT's composition means it is heavily invested in top-tier tech stocks, providing a focused approach to sector investing. This can be particularly appealing for those who believe in the continued growth and impact of the technology sector in our daily lives and the global economy. VGT might just be the dark horse for those looking to optimize their investment costs further. We've compared, we've analyzed. Now, let's wrap up our ETF Showdown. Throughout this exploration, we've seen how expense ratios, compounded annual growth rates, and risk measures shape the performance of different ETFs. The Vanguard Growth ETF, with its notably low expense ratio of 0.04%, and the Invesco QQQ Trust, slightly higher at 0.2%, showcase how even small differences in fees can impact overall investment growth over time. In terms of returns, the Invesco QQQ stands out with a final balance significantly higher than that of the Vanguard Growth ETF, driven by a compounded annual growth rate of 13.88%. However, it's crucial to remember that higher returns often come with increased volatility and risk, as evidenced by the QQQ's higher standard deviation and maximum drawdown. Understanding these dynamics is key to making informed investment decisions. Moreover, incorporating strategies like dollar-cost averaging can smooth out investment risks over time, potentially leading to substantial wealth accumulation. This approach involves consistently investing a fixed amount of money into a particular investment, regardless of the share price, reducing the impact of volatility on the overall purchase. Now here's the kicker. QQQ has an expense ratio of 0.2%, but VGT, which is Vanguard Technology ETF, has an expense ratio of 0.1% and returns an equivalent amount almost in lockstep with QQQ. Remember to comment and subscribe for more videos like this.